Hello and welcome to this video on conflicting macroeconomic policies. In this video, we're going to look at the concept of conflicting policies and then look at some examples. So as we've established by now, the governments try and achieve their macroeconomic objectives through their use of macroeconomic policies. So for example, in the UK government is in charge of fiscal policy. The Bank of England is in charge of monetary policy. And again, the UK government is in charge of supply side policies. And different policies can have different effects. And sometimes those effects can conflict with each other. So, for example, an expansionary fiscal policy might be in conflict with a contractionary monetary policy. So one policy may impact on the outcomes or effectiveness of another. And we need to have an awareness of this and look at some examples. So let's start off with an example of supply side policies and fiscal policies being in conflict. So let's imagine we have a fiscal policy here that involves an increase in government spending. So for example, they're spending money on health or education or infrastructure or changing something in terms of tax and benefits. Now that increased spending might cause some problems in terms of supply in the short run. So for example, the increased spending on education and building new schools might cause bottlenecks in terms of the cement industry, or maybe raise prices of bricks or that sort of thing, which makes it more difficult for businesses, the other elements of the supply side in the economy, to function. However, in the long run, the spending might, once it's done, actually help improve the supply side conditions in an economy. A second example here might be a conflict between fiscal policy and monetary policy. Let's say there's been investment by government on infrastructure, education, or health. Now, this might also have an impact on the cost of production for firms. So if governments spend a lot of money, and to do this they borrow money, they might find they're using up a lot of credit in the financial markets and also pushing up the cost of credit, which is in effect the interest rate that other businesses will be borrowing from. So the situation here that because the government is borrowing so much to do its expansionary fiscal policy, that an effect of that is actually the interest rates that banks are using to charge businesses to borrow money are also rising. Now, if the Bank of England are trying to reduce market interest rates to have an expansionary monetary policy, they might find this difficult if actually interest rates are going up because the government are crowding out the private sector. Finally, let's consider monetary policies and supply side policies. Let's imagine that under monetary policy, interest rates have been increased to try and reduce spending to control inflation. Now, if we think about how this might impact on the effectiveness of supply side policies, higher interest rate costs may reduce investment that businesses might make, which may make it more difficult for the supply side of the economy to increase production. So here, the change in monetary policy and increase in interest rates has made it harder for supply side policies to be effective, because this may in turn reduce the levels of investment because businesses face higher borrowing costs. So in this video, we've looked at the concept of conflicting policies and we've looked through some of the examples. That's it. Thanks very much for listening.